If the recent market correction has got you worried, then stay tuned. We're going to explain what caused it and what you should do as an investor. Welcome to the week that was, where we break down all the big events from the week and explain how it impacts your money. First, the market. On September 26th, the Nifty 50, which is one of India's more popular broader benchmark indices, hit an all-time high at 26,126. Looking back at all the positive cues in the month of September, it would have made you believe that the positive momentum will continue. However, the markets have taken a steep U-turn and has headed only in one direction, down. In the last 6 weeks, the Nifty 50 has corrected over 10%. However, certain sectors have felt greater pain. Sectors such as defense, PSUs, real estate have corrected anywhere between 16 to 26%. Out of the top 1,200 stocks, 770 stocks have corrected over 20% and 400 stocks have corrected over 30%. If you have been an investor who have recently invested in thematic or sectoral mutual funds, you would have felt greater pain. It is for this reason at Fabits we avoid investing in sectoral or thematic funds. So, why is it happening? There are several triggers that are all intertwined, but we will simplify into 3 big reasons. First, foreign investors. We've been talking about foreign investors in the last few episodes. Foreign investors continue to withdraw money from India. In the last 6 weeks, they've withdrawn a whopping $15 billion. What is surprising is the pace at which they have pulled out money. Last time they pulled out such a big quantum was during COVID, when they withdrew about $10 billion over a 3-month period. This time it's $15 billion in just 6 weeks or a month and a half. So what are the triggers? It started with China. The Chinese government recently announced a series of policies or incentives to boost their economy. Remember, the Chinese company valuations are significantly lower than India. So the foreign investors are finding the Chinese markets a little bit more attractive than the Indian markets. This was followed by all the drama and action that happened in the US markets. We're going to dive into US specifically in just a little bit. But here's the good news. The total market capitalization, that is the value of all stocks put together, today stands at about $5.4 trillion. The foreign investors still hold 16% of this. So that $15 billion pullout accounts for only 1.2% of the foreign investor holding and just 0.2% of the overall market cap. So foreign investors still have a significant investment in India. The second reason is disappointing company earnings. The quarterly earnings announced by Indian companies so far has been disappointing. In fact, it is one of the worst in the last 3 years. And here's data to showcase that. The quarterly sales growth 3 years back stood at 25.7% and that has fallen down to 7.6% this quarter. The net profit growth, which stood at an impressive 38%, has fallen to negative 5.3% this quarter. 53% of the companies that have announced results have failed to beat the expectations. Add to this, inflation has not helped. Inflation last month has spiked to about 6.3%, much higher than what the street was expecting. 3. The dawn is back. Donald Trump is back in the White House and this has brought a lot of cheer in the US markets. His policies such as Make in America, improving ease of doing business and cutting corporate taxes has propelled the US markets to new all-time highs. This, along with the fact that the US economy is growing really strong. The growth rate has been 2.8% last quarters, which is very impressive for an economy of this size. The company earnings have further boosted the US markets. 53% of the companies that have announced results have beaten expectations, and on an average, the profit growth has been 8%. Two contrasting pictures. 8% growth in the US, minus 5.3% profit growth in India. So it's not surprising several of these foreign investors are moving funds back to US than investing in India. Here's the silver lining. Despite all of these challenges, Indian markets have done fairly well thanks largely to the strong domestic flow of funds. In October alone, domestic investors have poured in over 44,000 crores into the markets. The year-to-date Nifty 50 gains still is positive and is over 5%, which isn't so bad considering that last year was a blockbuster year. So now we come to the most important question: what should you do as an investor? We expect the market volatility to continue for the next 3 to 6 months before we start seeing some positive momentum. If you are a long-term investor or have been investing for a long time, diversification is key. Spreading your investments over different asset classes such as debt, gold, and international markets that includes US markets will help reduce volatility and reduce your risk. At Fabits, we do this diversification on your behalf and ensure the investments are well aligned with your personal goals. And it is for this reason most of our funds have outperformed the index. Take for instance our retirement funds, which have returned 7.8% since April 1st, whereas Nifty 50's return stands at just 4.5%. If you're a new investor, any time is a good time to start investing. However, this 10% discount in the market has made investing a little bit more sweeter. If you don't know where to start or how to go about investing, do reach out to us. Remember, such market corrections are normal and in fact is healthy. So stick to your SIP, stay diversified and rebalance frequently. If all of this is overwhelming, let Fabits do it for you. On that positive note, we come to the end of this week's session. Do like, subscribe and share. If you have more queries, do write to us. Past performance is not a guarantee of future returns and investing is subject to market risk. So please read related documents before investing.